In this example, we will be doing exercise 1211 that can be found on your textbook on page 567. We are going to do the journal entries to admit a new partner that is contributing assets and a partner who is purchasing an interest from the existing partners in the partnership. The question tells us that the capital accounts of Aaron Gardner and Ricardo Fernandez have balances of $180,000 and $120,000 respectively. Aisha Carpenter and Isabel Diaz are to be admitted to the partnership. Carpenter is going to buy 1/5 of Gardner's interest for $50,000 and 1/4 of Fernandez's interest for $32,000. Diaz is going to contribute $90,000 cash to the partnership, for which she is to receive an ownership equity of $90,000. So, in this example, we are adding two partners to the existing partnership, and each one is being added differently to the partnership. So let's start with Carpenter. They tell us that Carpenter is going to buy 1/5 of Gardner's interest and 1/4 of Fernandez's. This is telling us that Carpenter is purchasing an interest rather than contributing assets to the partnership. So, when we look at adding Carpenter to our business, we have to determine how much is she purchasing from each partner. They again tell us that she is going to buy 1/5 of Gardner's interest and 1/4 of Fernandez. So she's going to buy 1/5 or 20% of Gardner's interest and 1/4 or 25% of Fernandez. So we simply multiply the capital balance of the existing partner by how much Carpenter is purchasing to determine how much of that partner's capital balance she will receive. So for Aaron Gardner, she's going to be taking $36,000 worth of his capital. For Fernandez, again, we take the $120,000 and multiply it by the 25% that she's purchasing. She will take $30,000 of Fernandez's capital. They tell us that she's going to get the $36,000 or 20% of Gardner's interest by giving $50,000 to Gardner and getting $30,000 of Fernandez's interest by paying $32,000 for it. The $50,000 and the $32,000 is irrelevant to our problem. Carpenter is giving the $50,000 and the $32,000 directly to Gardner and Fernandez. She is not giving that money to the partnership. So, to journalize this entry, we would debit Gardner capital for the $36,000 that he is giving up. We would debit Ricardo Fernandez for the amount that he is now selling to Carpenter, which in this case is $30,000. And we would credit Aisha Carpenter capital balance for the full amount of the $66,000 that she has purchased from the two existing partners. Again, notice here that there is no cash being contributed to the partnership. The $50,000 and $32,000 are given directly to the partners as a personal transaction. We can now add our next partner to the partnership. They tell us that Diaz is going to contribute $90,000 cash directly to the partnership and will receive ownership equity or capital of $90,000. So that means the cash of the partnership will increase by the $90,000 that was given. And they tell us that in return, Diaz's capital will be $90,000. Diaz has contributed assets to the business. So the assets of the business in total increase, and Diaz's capital happens to increase by the same amount. Because what Diaz is giving equals what she is getting, there is no partner bonus for Diaz's contribution. In Part B, they want us now to determine the capital balances for all the new partners. So we have Gardner, Fernandez, Carpenter, and Diaz. Gardner started with $180,000, but sold $36,000 worth to Carpenter. And we saw how we decreased Gardner's capital with the debit, dropping Gardner's capital balance to $144,000. Similarly, Fernandez started with $120,000 in capital, but sold $30,000 worth to Carpenter. Therefore, Fernandez has a $90,000 balance in their capital. Carpenter, we credited the Carpenter capital for the total that was purchased of $66,000, making Carpenter's balance now $66,000. And we credited Diaz capital for the $90,000. Therefore, their capital balance is $90,000.